We've been trained to think of corporate security like a physical vault. If the doors are thick and locks complex, the assets inside are safe. For decades, companies have applied this logic to their digital networks, relegating defense to technical teams as a standalone silo. This creates the IT illusion, the assumption that firewalls and antivirus software naturally protect the economic reality of the business. On the left is the IT interface, tracking blocked malware. On the right is the CFO's view, cash flow and statutory reporting. Every financial operation relies entirely on deeply interconnected digital data pipelines bridging the two. Watch what happens when a threat bypasses the perimeter using a stolen credential. They don't deploy malware, they simply log in and alter a single vendor's bank routing number within the enterprise systems. To the IT department, this looks like a minor compromised endpoint or a routine password reset. To the finance department, it is a direct, unrecoverable drain on treasury liquidity. This introduces the concept of consequence ownership. IT builds and monitors the system architecture, but when that architecture fails, finance owns the economic fallout. Delegating cyber exposure entirely to security teams ignores the financial reality of the data. For financial leadership, this gap in oversight creates a direct vulnerability in the organization's economic stewardship. So, what specifically must occur for a technical vulnerability to cross the threshold into a material financial risk? The benchmark is clear. A risk becomes financial when it threatens your asset values, the credibility of your reporting, or your ability to execute transactions. Ransomware targets operational servers to encrypt critical files, effectively halting the month-end statutory close and freezing invoicing pipelines. This creates a rapid contagion effect. Operational delays force teams into urgent, manual workarounds. Suddenly, staff are bypassing established internal controls and overriding the segregation of duties just to keep the business moving. Whenever digital exposure threatens the credibility of an organization's economic representation, it ceases to be an IT headache. It immediately becomes a core governance mandate. Corporate defense usually fails when companies treat all cyber attacks as generic technological vandalism. We have to look at the specific actors and their economic motives. Many of these attackers operate like professional syndicates. They stalk corporate approval workflows, studying process weaknesses the same way an auditor studies inefficiency, waiting for the right moment to strike for maximum economic return. These groups understand corporate timing. They strategically target periods of high stress, executing their campaigns right before quarter-end reporting or during major acquisition announcements when staff are distracted by deadlines. This risk taxonomy matrix plots threat actors on the vertical axis against specific financial impacts on the horizontal axis. Look at the intersection of external criminals and liquidity impact, business email compromise. This attacks human habits rather than software vulnerabilities. Attackers manipulate executive urgency and corporate authority. They spoof an email from the CEO or a key supplier, bypassing dual approval controls and forcing an unauthorized cash disbursement before anyone verifies the request. This targeted, direct extraction method is highly precise, contrasting sharply with the broader, indiscriminate operational extortion tactics utilized by modern ransomware operators. The most devastating financial losses occur when technically simple methods successfully exploit the inherent trust built into your financial reporting chains. This brings us to a dangerous paradox in digital finance, the conflict between system availability and data integrity. When a server goes offline, weighing down availability, it's a visible operational nuisance. Customer billing stops. But integrity loss is a silent corruption. Master data and critical journal entries rewrite themselves beneath the surface, while the system appears completely normal. A perfectly online but inherently untrustworthy ledger undermines the entire basis of management decision-making. You are operating on numbers that look precise but are completely false. The worst-case scenario occurs when ransomware groups secretly alter financial data before launching their encryption payload. They maximize their extortion leverage because the damage is already embedded in the numbers. This creates a post-incident nightmare. The IT team restores the systems from backups, declaring victory, but the finance team can no longer guarantee the completeness or accuracy of the restored data. This specific integrity failure directly triggers audit qualifications, delayed public disclosures, and collapsed external assurance. For CFOs and external auditors, preserving the absolute truth of the data is far more critical than merely keeping the servers running. We also have to expand the perimeter of the threat. Modern organizations rely heavily on external cloud platforms and third-party payroll processors to execute daily operations. The legal reality is harsh. Transferring operational tasks to a third-party vendor doesn't transfer fiduciary accountability. If their system fails, it is your reporting error. A service provider breach acts like a single falling domino. It triggers a massive chain reaction, cascading external vulnerabilities directly into internal financial workflows. Vendor contagion costs compound immediately. You face forensic investigation fees, emergency consulting support, and unquantifiable contingent liabilities. The sudden inability to access supporting contracts or vendor data halts your statutory reporting timeline, forcing immediate regulatory disclosures regarding the disruption. And when you file a claim, insurance recoveries frequently become contested. The complex boundaries of shared responsibility models in cloud environments make it difficult to prove exactly where the fault lies. Third-party digital dependence creates a massive, hidden internal control vulnerability that traditional audit frameworks frequently fail to assess. The solution requires firmly embedding cyber risk within the broader enterprise risk management architecture. Presenting raw, contextualist technical telemetry, like firewall blocks or missing patches, at a board meeting is useless. It doesn't tell leadership how the business is actually exposed. We must take raw technical data streams, funnel them through a filter, and translate them into measurable financial consequences. Instead of reporting server uptime percentages, translate that metric into maximum tolerable downtime for payroll, misstatement risk probabilities, or cloud vendor concentration limits. Redefining risk appetite in these economic terms forces the board to make actionable business decisions based on financial thresholds, rather than passively reviewing IT updates. Effective executive governance is impossible until risk data speaks the language of economic impact. Finance professionals must evolve their mindset, applying the exact same rigorous accounting skepticism to digital systems that they already apply to balance sheets. Do not fall for the false comfort provided by visually polished automated reporting dashboards. A clean interface can easily mask underlying data corruption. A perfectly formatted report holds zero value if the underlying digital pipeline connecting the enterprise systems to the ledger is compromised. When those digital pipelines are breached, it destroys the structural integrity of your financial reporting, fracturing the foundation of your accounting evidence. Perfect, impenetrable cybersecurity is a technical impossibility. But rigorous and documented accountability over your control architecture is a non-negotiable legal requirement. Because digital systems now mediate economic truth, finance professionals must actively govern conditions of that trust.